Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. It's full-on summertime. We got an amazing show with two amazing guests. You know, I was hanging out in one of our living rooms having a conversation with these two. I didn't want it to end, so I said, you got to get them on the podcast. You'll recognize one of these listeners, Dan Rasmussen from Verdad. He's been on the show, I don't know, 3, 4, 5 times, so I don't even need to do an intro for Dan. But our friend D.A. Wallach is a first-timer. And so instead of me reading an intro, I thought I would ask our new friend, Meb AI, and say, Meb, give me an intro for DA. So it says, today's guest is someone who's truly impossible to characterize. A Harvard-trained musician who toured the world with Kanye and Pharrell, who's also been one of the most thoughtful biotech and frontier tech investors you'll ever meet. D.A. Wallach is kind of the guy who can talk fluently about mRNA vaccines, the future of AI medicine, how Spotify changed music, what it means to create a zero-toll healthcare system, and somehow make it all connect. He's invested in early companies like SpaceX, Ripple, Doctor on Demand. He writes one of my favorite newsletters on innovation, health, and the future of care. Today, we'll cover everything from how artists think about investing to where modern medicine is going, to the Overton window of crazy ideas that might not be crazy after all. Buckle up. This is a wide-ranging one. DA, welcome to the show. How did that do? Did that hallucinate a little bit?
I'm not objecting. I'll take it.
I asked another question because I said, I'm trying to think of all the musicians, former, current musicians that have become, kind of famous investors, professional investors. And you've seen a lot that have become entrepreneurs. But I was like, and so then I asked ChatGPT again, and I said, who are kind of the top 10? And it spit back, and you guys could probably guess some of these. Number 1, it said Jay-Z. Number 2, it said Nas. Number 3, it said DA. Number 4, it said Will.i.am. 5, Bono. 6, Pharrell. 7, Akon. 8, 50 Cent. And Snoop Dogg.
I'm ahead of Snoop. That's pretty impressive.
So you made the top 10, man. Congratulations. Anyway, there's a lot of topics I want to get into today with you guys. I thought we'd start with you, DA, because you're the newbie. Talk to us a little bit about, I've never heard, you kind of made the progression from Spotify to VC managers. You got a $100 million fund now, focusing on most things healthcare, biotech. What was kind of that next step? I'm not sure I've ever heard you tell the story.
You mean the step in between?
I don't know if there was one, or you just cannonballed into the pool. Could have been.
There was a step in between. So the way I think about it, I've basically had 3 careers, and I'm on my 3rd right now. So the first was, of course, my music career. And then I unexpectedly ended up in the investment business when I met the founders of Spotify at this point about 13 years ago. And it just happened that they were doing something in the industry I knew something about. So that was my first investment. And on the heels of Spotify starting to take off, I thought, wow, investing is so easy. All you do is you find a product that you really love and you put some money into it and it takes over the world. And so I very naively, on that basis, went looking for other companies that I thought had that kind of potential. Of course, there aren't many of them. And it was what turned out to be a golden age of company formation in the past decades. So I met Elon Musk, over a decade ago and invested in SpaceX. And I met Aaron Levy from Box.com and put some money into that. And Ripple was just getting started in the cryptocurrency world. That seemed like a very weird emerging area. It wasn't yet a hot topic. It wasn't something that everyone was thinking about. And I thought, wow, these guys are trying to reimagine the entire internet and all web services in a decentralized way. What could be more revolutionary than that? So I made a little seed investment in Ripple as a seed company. Anyways, I cast this sort of very wide net across different industries. And through that, started to learn the venture business just as an angel investor. And it occurred to me as some of these started to take off that, wow, if I was doing this with real money, we could retire on my boat pretty soon. And so I had this big break, which was meeting a guy named Ron Burkle, who's a big, highly successful investor based in LA. And Ron, to his enormous credit, changed my life by saying, look, I'll back you and don't, keep writing $20,000 personal checks. When you find something good, bring it to me. I'll give you the capital and I'll pay you like a fund manager. And so that allowed me to scale up and really start doing this professionally. And somewhere along the way, I made an investment in my first healthcare startup, which was called Doctor on Demand. And through that experience, had my eyes open to just how screwed up the US healthcare system was. And I always think in venture capital, you're trying to look for areas where technology is going to fundamentally transform the way a sector works. And it seemed like healthcare was one that was poised to dramatically change if technology could kind of do there what it's done in some of the other sectors we're all familiar with. And so I started spending a lot of my time in healthcare and biotech. And that's basically been the last decade. So 4 years ago, decided to set up our firm. And I did that with my partner, Tim, who is a great drug developer, used to run drug development at Novartis and has brought, at this point, I think 21 blockbuster drugs to the market. And we hung our shingle and started Time BioVentures to keep investing in healthcare and biotech startups. And that's what we do.
And where are you guys on in this fund one? Are you fully deployed? Are you slightly deployed? I guess most of VCs I know are always raising fund 2 and 3, but where do you kind of stand today?
It's an interesting question because about a year and a half after we started, and Dan's going to talk about this, I think biotech went into like the biggest drawdown it's experienced in 2 or 3 decades. And so it has just been absolutely crushed as a sector that has been most manifest in the public markets. Private markets obviously pretend like nothing's wrong as long as they can. And we've sort of been in that liminal period for a while now. But it's become a very challenging sector, both for the public guys and for the private guys. So we've invested very cautiously. We've kind of drawn out the investment period here to not rush into things that were imperiled by the financing environment. So we're almost done investing our first fund. Like most venture drawdown funds, you have a 5-year investment period. We're just heading towards the end of that. And we've got 17 companies in our portfolio now.
You've been investing in biotech all through this drawdown. Like, what went wrong for biotech? Like, what caused this kind of collapse in valuations and total investor flight? I mean, why is biotech trading like coal companies?
There are multiple variables at play. I'd say interest rates is the top of the list. And biotech, I think as you dig into it, you realize is a sector that's probably more sensitive to cost of capital than almost any other sector. And that really is because these companies are they're more like options in the sense that by design, they lose money for 8 to 10 to 12 years. And then they either generate a huge bolus of cash flows or they don't. And so when rates move up or down, you're discounting cash flows that are 10 or 12 years into the future. And so they're incredibly sensitive to rates. So I think the first sort of shot was that rates went up. That was incredibly damaging. And then the second thing that happened was, I think the relative opportunity set for public investors shifted, particularly as AI kind of came into the picture. And so a lot of the generalist hedge funds and the big mutual funds, so we're thinking Fidelity, T. Rowe, Janus Henderson, they all basically en masse rotated out of the sector. And there are some very successful, decently sized biotech hedge funds, but they can't on their own carry IPOs. And so when the generalists rotated out of biotech, and they've basically remained out of biotech, the public biotech specialist hedge funds were left in a situation where they could not unilaterally support IPOs. And what happened from there was that nothing could go public. And therefore, all of the late stage private investors had to devote all their capital to keeping late stage private companies solvent that they had been planning to offload onto the public folks. And that has backed up all the way to folks like us, whose business is basically to manufacture companies for those later stage private investors to focus on, and then ultimately to pass on to the public. So I think of it like a conveyor belt, and basically the conveyor belt has been shut down for 3 years.
Dan, you want to talk to us about, some of your research here, because there's a couple commonalities the three of us have, not just dads, not interested in markets, but, one is, and I feel like Dan, like, you've studied crisis a lot. I actually, when I hear lost decade, I get excited, right? A lot of people, when they hear, that's maybe the contrarian to me, something's down. I mean, I kind of cut my teeth at a biotech mutual fund right out of college that I think as soon as I joined, it went down like 80 or 90%. But I used to look at biotech over the years, and I'm not one for cycles, but there was almost like every 4 years, a miniature boom and bust in biotech. And here we are, we're kind of that 2020, 2021 peak, fast forward 4 years later in that valley where pull up the ETF, and it's been slim pickings for a decade now. Dan, you want to give us a little overview of what you're seeing?
Yeah, so I really got into it for two reasons, and I'm new to the biotech world, but there are two things that got me interested. One is that the biotech sector, I think, is in a 60% drawdown from the peak, and we've generally found that once something is down 50%, that's sort of a big threshold, right? When an asset class, let's exclude asset classes like that are going to go to zero or have the potential to go to zero, but some reasonable sector of the economy that's not going to go to zero. When it's down 50%, that's generally marks something that's pretty interesting. So I'd say the first thing that got me interested in biotech is just these things have just been annihilated. And, it's never good when the deep value guy that specializes in like Japanese nets is interested in your asset class. Like, it's usually a bad sign. It's like the Grim Reaper has arrived. Like nobody's like, okay, here come the deep value guys. Like Meb's going to feature us on his 3-year drawdown industry list. It's not like, nobody's happy about that. But I think biotech is sort of there where, and I think as a small cap investor, biotech's a big portion of the US small cap universe. It's like 20-30% of the Russell 2000, right? So if you're a specialist in small caps, like you're going to see a lot of these things, and you got to sort of figure out a way to solve them. And sort of the second thing that really got our current sort of project or interest in biotech started is that we were looking at our factor model. And we're doing a process we call debiasing, which is where we look and say, hey, is our model biased one way? Where is it making mistakes, or what's it getting wrong? And we noticed in the tails, it was making some pretty big mistakes. And so we said, okay, well, what's causing these mistakes? And we very quickly realized that it was biotech, and that biotech, just your standard Barra model, just doesn't apply well to biotech. And I'll give you the classic example, which is value. So if you think about like a classic value model, which would be EBITDA over enterprise value, most biotechs have negative EBITDA, and so they look horrendous. And then you also think about the denominator of that, and the bigger that denominator is, the bigger the EV is relative to that money losing EBITDA, the worse it's going to look on a model. And so, basically the companies, the biggest EV and the most negative EBITDA look like the worst biotechs. And so our model would want to short those. And then it would actually find out that it made a lot of mistakes versus the company that had tiny negative EBITDA and tiny EV, which it said actually seemed like the cheap biotechs. And when we started to look at it and unpack it, some of the first things we did is to start to correct these metrics. So one of the things, for example, that we found was that, and this is all very logical, but like cash runway matters. So actually, because in biotech, most of the EV is cash, companies with more cash and therefore higher EVs generally do better than companies with less cash and lower EVs. And actually, when it comes to spending, because you have to think about not like the negative EBITDA, it's about how much they're spending. And so it turns out that spending more is often a good sign, right? Like a firm that's spending $200 million a year on research is often like a more interesting company that's one that's spending $10 million a year on research. But because that's showing up as negative EBITDA, it's screwing up your value metric. And so that sort of was what kicked off our research into biotech of saying, hey, we need to fix our factor model. And we're going to do it in an industry which actually looks kind of interesting because it's in such this massive drawdown. And I put together a few slides, and I'll walk through them very quickly from the beginning because they're sort of an interesting framing. And I would caveat this with, I know nothing about biotech, okay? I have the view of the quantitative numbers, but I don't know anything about the companies or the industry or what's going on. But I'd say the first thing to note on slide 2 here is that biotech's returns, since biotech sort of interestingly relative to consumer staples, I'm showing consumer discretionary, right, over the long period of time has basically done equivalently well to consumer staples or consumer discretionary, which is sort of interesting because these are science projects in many cases, but they're doing just as well over long periods of time as, consumer staples businesses, right? So there's something real about these biotech firms that's making money, but that has decoupled since about 2020 or 2019, where biotech's been in this massive drawdown. And so it's fallen off the line of being roughly in line with other sectors. And now it's sort of in this dark period by itself. And when you look on the other side of the slide, what we show here at TEV relative to spending, our sort of value metric, and you can see that that's just collapsed, right? So there have been some big booms, the late 90s, that 2015-16 period, 2020, 21. But recently, valuations have just collapsed in biotech. And then, when you're thinking about biotech in context of the rest of the world, biotech's pretty interesting because it's very uncorrelated, which isn't surprising, right? It's its own world. That's one of the least correlated sectors. So if you're looking for diversification or some weird bets to take, this is a good place. There are a lot of biotechs. Here you can see they're at 357. These are all in the Russell 2000, by the way. So, right, huge percentage of small cap stocks are biotech, but they're tiny. The average market cap is the smallest by far of any industry. And most companies are essentially pre-revenue, right? So they're the smallest by revenue, smallest by gross profit, right? Because the vast majority of them are negatively profitable and generate no revenue. Biotech is also very, very volatile, and therefore, certainly on the recent numbers, very low Sharpe ratio relative to asset classes. But that very high volatility also creates these sort of lottery tickets, right? Which is what is also sort of seductive about this industry, right? There are lottery ticket upsides to be had in biotech, more so than almost any other industry. This is the lifetime return percentiles. And you can see that on the right-hand side, biotech has this big right tail, right? Where there's these lottery ticket outcomes, and like your top 10% of biotech stocks are just much better than your top 10% of other sector stocks because they're the sort of, you get massive returns on them. But on the other hand, your median biotech stock loses a lot of money in its lifetime. And actually, you have to get to like the 70th percentile of biotech stocks before you get firms that are lifetime profitable. So biotech beta is bad, right? Like generally, like investing in science projects is a bad idea because most science projects, you spend a lot of money and, you end up with something that doesn't work. And it's only in some very small percentage of cases that you earn these crazy returns that then make up for all the losses and gives you that sort of consumer staples level result. But this is a sort of a fascinating set of quantitative characteristics for an industry. So I think this is a helpful framing for how weird biotech is. And again, I think it'd be fun to hear sort of DA's impressions of this as somebody who actually invests in this stuff and knows it really well. Because I'm just looking at it from this 30,000 foot view and saying, wow, relative to the rest of stuff you might look at as a quant, this is some pretty weird stuff, and it seems pretty interesting and fun to look at.
Yeah, I mean, I totally agree with the observations you have, Dan, and it's interesting and sort of gratifying to me to have such a notorious hater of active management as you come into our sector and see these things, because really that extreme dispersion that you see across the companies and the fat right tail is what justifies the existence of active alpha here. And there are people from an academic standpoint, like Andre Perold, who you guys may know, who runs High Vista. That's a hedge fund of funds. And Andre has, significant concentration in biotech hedge funds because there's a lot of evidence that there's real alpha to be generated there. And the managers who have survived in the sector have been around for quite a while and have consistently demonstrated that skill. To your point, you just simply, there's no good passive way to invest in these companies. You have to be selecting stocks. And that's why I think it's one of the last bastions.
You just got to pick the winners. Easy. While we're on healthcare, let's hang here for a minute. DA, you've written a couple of pretty cool articles over the past year. Zero toll medicine being one. You want to talk to us a little bit about just healthcare in general? I mean, we've been focusing on biotech, but I don't think you focus purely on biotech in your fund. Talk to us a little bit just about where you're seeing opportunity today. I mean, there's a lot of shifting forces, man. GLP-1s, gene therapy, CRISPR has kind of taken a little backseat, the GLP discussion lately. But what's going on? Where are the winners going to be for coming down the pipeline?
Yeah, I think there are two frontiers that are kind of moving very rapidly in parallel. And the first is basically biopharma. If you think about what happens when you get a really bad disease, there are sort of two general types of solutions for you. One is a human services centric healthcare solution. So, like, let's talk about obesity treatment before GLP-1s. You're going to get a nutritionist, you're going to get an endocrinologist. You might be put on some medications like metformin that are going to help, modulate your blood sugar. But basically, it's going to be very challenging to get you to make the lifestyle adjustments that are needed to control your disease. And it's all going to be managed by people, and you're going to see all those people in hospitals, and all that's going to be paid for by your insurance. And that insurance is going to be paid for by your employer or by the US government, which is to say everybody. So that is an expensive, cumbersome way to take care of people. And by contrast, with the advent of GLP-1s, you're going to stick a needle in your leg once every 2-3 weeks, and you're going to melt. And so if you think about pharmacology as the greatest tool in medicine's armamentarium, it's been an unrivaled success. And while there's a lot of public policy debate over how expensive drugs can be when they come out, and make no mistake about it, that's because the government gives drug companies legal monopolies through the patent system, and they extract a lot of profit as a result of that. Ultimately, drugs go generic, and then they're free for the rest of human history. So the most cost-effective spending we can do on medicine is basically to invent more drugs that actually cure diseases, because that obviates all of this downstream spending. And to the extent that we can't do that, I mean, we're not going to have a pill that fixes broken legs. That's always going to require surgery. But the system that we've built to do things like surgery, everybody knows is ridiculous. It's ridiculously expensive. It's ridiculously inefficient. The patient or customer experience is horrible. Everyone hates it. It's bankrupting America. And what's interesting right now in the sort of healthcare delivery side of things is that I think AI actually is going to democratize access to gold standard medical knowledge to every person in the world. And whereas in many areas, AI is overhyped and speculative, and you kind of have to make a bunch of crazy leaps to believe it's going to upend the way we do things, in medicine, I think we already have technical proof of concept that these machine learning systems can basically do 80% of what physicians do. And so we're moving from a model where we spend $300,000 or $400,000 to educate geniuses until the time that they're 32, and then send them into the world with all this knowledge in their brain to practice medicine. And we're going to move to a world where basically for free, everyone has the greatest doctor in the world in their pocket. That's going to be a major shift. And hopefully it undermines this crazy system that we've built in the period where we haven't had that.
It's an interesting idea because I hear a lot about like Medicare reimbursement trends, or like obviously like to solve the budget deficit. We need to solve some of the Medicare and Medicaid spending because that's what's driving it. But I'd never thought of drugs as the answer, right? I'd always thought of them as part of the problem. But I think when you put it that way, right, like that it's the hospital spend and it's the doctors that are the costly part. The drugs are actually a low-cost solution. And I think that's a very interesting insight.
No, I think that's right. And I think there are, you mentioned, Meb, this zero-toll medicine essay I wrote. That is about an idea that I've been championing, which is kind of crazy. It's meant to be provocative, but it's an idea about how you can put patients in control of United States healthcare spending. So we try to do all these things through public policy incentives like Medicare Advantage. Now, more than 50% of elderly who are on Medicare are choosing Medicare Advantage. That's basically a privatized Medicare system where the government pays private insurance companies to deliver Medicare to people. And the whole impetus for that was we're going to sort of align the profit incentive of these insurance companies with the idea of delivering high quality care for patients at as low a cost as possible. In other words, the government is going to basically give bonuses to insurance companies if they can figure out how to treat people at a lower cost. And it's kind of been a mixed success, too hard to call at this time. But my thought was we could use cryptocurrency, and forgive me, I know that sounds stupid, but we could use cryptocurrency to give every patient in America a digital healthcare wallet. And anytime something goes wrong with them, say they break their leg, what we do is we deposit into their wallet crypto tokens that are programmed so that they can only be spent on treating broken legs. So you can't go spend them on an eye doctor. You can only go spend them on a, orthopedic surgeon. And then we actually allow patients to get bonused out if they are able to achieve high quality medical outcomes at a lower than average cost. So I view this as kind of like a perfect synthesis of libertarianism and a kind of like egalitarian social safety net concept where, the government, ultimately, we, the collective, pay for people's healthcare. It's been that way for a long time. It's probably going to stay that way. But we need a better mechanism to make the spending smart. And I think putting the power in the patient's hands is the best way to do that. And I think you can do it with crypto in a way that you couldn't before.
I'm filled with fear imagining people like purposefully breaking their legs to get DA's new healthcare crypto tokens.
It's like the examples they always talk about, the snakes, paying for the snakes, getting rid of the snakes in the town, then everyone starts breeding the snakes,
Oh, yeah.
But it's interesting, though, and you start to think about the incentives, right? You say, hey, it's like the company healthcare incentives. If you're going to be healthy, if you're going to quit smoking, if you're going to on and on, you can get cheaper insurance, you can get better benefits. There's definitely something there. As you look through, the beauty of your job, DA, is you get to kind of look around the corner of what's coming next, the next 3, 5, 10 years even, trying to look for these big winners. And you've mentioned you've deployed over a dozen kind of investments already. What are you seeing on the horizon for some of these ideas? What are you excited about when it comes to your world?
I mean, to Dan's earlier points, the only negative in our sector right now is that there's no money. The innovation is out of control, and we've all experienced it. So you could, I know, Meb, you were one of the first people to tell me about sort of a bad experience with the COVID vaccines. But think about that. We had a totally unproven technology, mRNA, that had been percolating for 10 or 15 years. And we faced this massive global health emergency. And it's like within a year, we've got multiple vaccines that more or less work. They work for a lot of people. And that was a technology that had never been in humans before. And in such a short period of time, it's like, wow, a whole new modality that we now have at our disposal. And a few years before that, we had the first human cell therapies where we're literally taking immune cells out of a cancer patient's body, genetically engineering them to turn them into essentially micro robots, and then putting them back in the patient as a drug. And we've got bispecific antibodies. We've got antibody drug conjugates. These are all broad general purpose technologies that have essentially come online in the past 10 to 15 years. And so the prospects for drug development to be a less risky and probabilistic endeavor than it has been in the past are greater than ever. And I think among intelligent people, there's a complete consensus that biological technology is one of the three most exciting areas in the global economy for the rest of our lives. I mean, what is it? It's AI, it's biotechnology, maybe it's climate or energy technologies. You can basically look at the priority list of the CCP if you want to know what the future is going to look like, because they're all over it. And we're in a war with them. So I think you've got this tailwind of a global technology arms race that we are in the midst of. And for those of us who are unlucky enough to be investors in this market right now, We just got to figure out the finances of it. And I think, Dan, I'm really curious with your outsider perspective as you started to look at this, how you think about predicting cross-sectional returns or volatility, because we talked about the space as a whole having negative expected returns. But as you start to parse some of these potentially novel factors, what have you figured out in terms of whether there's a systematically rigorous way to address it?
Yeah, I mean, I think that the challenge here, I think there's some things that quant does really well. Quant can do really well at risk management and diversification. Quant can do a very good job of telling you, hey, you need some of this and some of that and some of this. And it can do a rough job at ranking. But where quant is not good is saying, hey, this technology is going to work or not, or it just has no insight into that. So I think what we've been focused on is saying, how can we sort of map the biotech landscape from a quant or risk management perspective to understand it better? And I think there are a few observations. One is that some of these traditional value metrics, if you flip them and make them work for biotech, are good, right? Like actually having cash runway is better. Actually having more spend might be better. Companies that actually earn revenue or gross profit are different from companies that don't. And then I think that you probably want diversification across the different parts of the biotech universe, right? That is risk mitigation, right? You don't want to put all of your money into mRNAs, or you don't want to put all of your money into services, or put all of your money into, whatever, any one bet. And so once I think you can start to map the landscape and say, hey, you need diversification across these different modalities or different indications. You want to understand the risk profile and know that a company with $3 billion of cash on the balance sheet is a pretty different risk profile than one with $50 million of cash on the balance sheet, for example. You can start to, I think, map out a strategy for thinking about biotech within a quantitative framework. The only piece that's remaining is to sort of pick the winners and get the lottery tickets right, which quant is not good at. But I think where quant is really good in biotech probably is shorting, because 70% of these companies are going to lose money. And I jokingly say, the 200 million of market cap company that's solving cancer out of an office that's in a strip mall in Miami, probably not going to work, right? I mean, there's some sort of heuristics of the things that aren't going to work that I think are relatively easily identifiable, even if picking the winners is very, very hard. So that's sort of where our research has been focused, of saying, hey, can we kind of figure out what the risk factors are, the things that spread or create variation within returns, and what are the different parts of this universe and how do they trade differently? Probably the biggest one is the sort of service providers trade very differently than the companies that are actually producing drugs. But there are a lot of these other sort of interesting dynamics going on within biotech because it's such a big universe, 300-400 stocks. There are these different subsectors that you want to understand and map.
You're making me think we should have a short Florida strategy in general. I wonder historically how Florida headquartered startups have fared.
Yeah, it's like a Long Island-based financials.
Utah's got to be up there. Metals and mining, Utah and Vancouver, those two are fraught with problems, if I recall. That's a great, what domicile is the worst?
Yeah.
We're going to pivot a little bit. We can tie back into this anytime you guys want. But when I queried my AI for questions for you all, it had one for both of you. But for Dan in particular, going back to you were one of the first guests on the podcast. I mean, let's call it maybe 7 years ago. And the AI question, which I'm pretty sure I know what you're going to answer this with, and it's talking about, you got a lens on the future. What's one big idea? Could be a belief, investment theme, worldview you think is glaringly obvious, but most of the financial world still gets dead wrong. And I'm going to trigger you real quick, Dan, and it's okay. This is a safe space. But last year, I don't know if last year was kind of peak private equity when in terms of thinking like leverage buyout, that leverage buyout sort of late stage private equity world. And Dan was talking about this a long time ago. Last year, Citi had asset class predictions and said that private equity their predictions for the future was 19.5%. In which I said, can you not just say 20? Like, why did you stop at 19.5? That's so specific. And then the single largest allocation last year for American family offices of any asset class strategy was private equity. And then third was if you look at the world's top pension funds, et cetera, was that there's some funds like Kaiser has 50% in private equity. And then you start to see some of the rolling results where it's now 1 year, 3 year, 5 year. I don't know if it's 10 year, probably is, where private equities underperform kind of market cap benchmarks. But you wrote a piece in the Financial Times recently. You want to give us kind of the overview of what you're thinking and talking about here 7 years later?
Yeah, Meb, I think it's funny because I think when I came on that podcast 7 years ago, people really loved hearing me talk about private equity. Like, that was a really popular podcast. Everyone liked hearing it. And I got a number of speaking invitations after coming on, and everyone liked hearing it and no one acted on it. I mean, it was sort of like hearing the funny guy at the party. Tell me why you think, I don't know, why is Taylor Swift a bad musician? And this guy's going to go off on a rant on why Taylor Swift is actually awful or something. And it's like sort of funny, but everybody's still like, yeah, but she's the best-selling artist of all time. So like, this guy's kind of funny, but he's just wrong. So nobody's going to not go to the Eras tour because Dan thinks Taylor Swift is bad. I don't have a view on Taylor Swift, but that was sort of the reaction, right? Where I think everybody in the institutional world thought private equity is the best thing since sliced bread. And the allocations you're talking about, like, I talk to people every day, right? I think like probably your median, like high-end family office, right? Who's got like the right clients, the right consultants and the right this is probably 40% in private equity now. Probably their charitable foundation might be 70% in private equity, right? Because everybody's just looked at these return forecasts and it's always like, take public equities and add 200 or 300 basis points, and that's going to be your forecast for expected returns for privates. And so, people have just said, well, if that's true, why stop here? Why would we only put 5% or 10%, right? And they've just taken up these allocations massively. But one of the things that's happened is that everybody's kind of reached max privates, and they actually reached max privates like 3 or 4 years ago, where there was just nobody in that world that hadn't maxed out. And then the funny thing happened where interest rates went up and valuations for smaller companies went down. And now all of a sudden, all the things that had been bought by private equity at that peak period are sort of unsaleable. Like, well, why are they unsaleable? Well, for one thing, as private equity grew and grew as an asset class, if it grew each year, there was sort of greater fool. There was some fund that was a $5 billion fund last time. It's now an $8 billion fund, and they're going to go buy stuff from you at more than you paid for it, as that whole asset class needs deals. And your previous fund is a good source of them. So sponsor to sponsor deals went up to like 50% of deals, which is also funny because people say, well, how is private equity going to outperform the market? And they're going to say, well, by improving the performance of the companies. You say, well, KKR owned it for the last 5 years and Blackstone for the 5 years before that. Where's this magic performance improvement coming from? So now you've had fundraising actually for private equity shrink the last few years. And because sponsors can't really pay for these prices anymore. And then you say, well, why don't you IPO them? And one of the interesting things you're missing there is that, well, private equity deals are really small and really levered. And I don't know how many small cap active public equity managers you've met recently, but it's a shrinking pool in the United States. So the idea that like active small cap public equity mutual fund managers at like Fidelity are going to be your exit for, Blackstone, Bain, and KKR's most recent fund vintage, like it ain't happening. And none of these things are big enough, or maybe like 1 in 50 of them are big enough to IPO into the mid cap or large cap index. So the exit, where are you going to exit? And they're so levered and they're borrowing at like 10, 12%. So all their free cash flow is going to interest payments, which means there are no dividends. There's no cash return. And so now all these institutions, not only had they over allocated and gotten to that 40% mark, but now they're not getting any distributions back. And so they can't re-up in any new funds. So the fundraising is getting worse, and the fundraising is getting worse. It means the exits are getting worse. So we're entering this sort of negative spiral, this sort of doom loop. And I think what's interesting is that really quickly, the narrative is changing around private equity. Where, again, I think a few years back, people thought I was the crazy guy, saying Taylor Swift was a bad musician. And now I'm starting to get calls like, hey, I think I might be over allocated to privates. What should I do about it? Or how did that happen? Or do you think my consultant screwed me over? Right. And you're like, it's such a different tone. And it's sort of shocking. And I don't know, I'd love to see some survey numbers. I haven't seen them, but certainly can see it in the fundraising numbers. Attitudes are shifting. And I think private equity is a long way down to go.
When I thought of your article, the word that came to mind that they probably wouldn't have published was constipation. And then you see, like, it's just like you have all this money, all these companies, and you look at kind of the private equity world where, in their head, they're like, we're going to invest in this and flip it within 5 years. And then you see some of these where it's like 5, 10, 15. But the big headline that I feel like the world took notice of, but then kind of has faded away, has Yale being like, hey, we're going to sell like 8 billion of private equity as a secondary. And I was like, wait, that's not like 800 million. That's like a giant portion. And to me, that was whether or not the foundation's endowments get taxed is going to be like a whole nother level of potential kind of problem.
It sort of revolves around a theme that we've all been sort of talking around, which is, when capital floods into an area, it creates its own momentum, right? As money flows in, it bids up the assets, and that sort of what creates these sort of asset bubbles in certain places, right? And then conversely, when the money flows out, things can just crater, right? There's just no bid. And your sort of industries that have had multi-year bad returns, right? That's the stuff that just has no bid, right? Because, after 3 years of bad returns, you're just like, people give up, leave the space, exit. And so I think my sort of mind is always looking for what are the places that are on the two extremes. And probably for the last 15 years, private equity has been on one extreme, and private credit right now is really, probably surpassed that. But those are the bubble industries, right? That's the stuff where easy money has flowed in, where stupid stuff has been done. And then conversely, you can go to the place where there's been crazy capital discipline like biotech and just say like, wow, like if you've survived that, you must have figured out something, because it's just been absolute annihilation.
Yeah, I just want to add, I think, Dan, one of the reasons I respect you and your work is that you're carrying on the John Bogle tradition in a sense. And there is a neglect among asset managers of just how extraordinary an accomplishment public markets have been. Our public markets are the crown jewel of global capitalism. And you've got an industry that is just so dominated by principal agent problems and self-serving behavior that everyone, from the people working at the pensions to the managers themselves, have every financial incentive to grow the private market. This is really the counterpart to the commoditization of public equity investing, because essentially all these active mutual fund managers had their business model destabilized with ETFs. And now what they used to do is free. So they've got to find something where they can continue to charge people. And for almost all of them, that has become, look how great private assets are. And look how great I am at sourcing and managing private assets. And that's why you should pay me 2% instead of nothing for the ETF. And that is maybe just getting started. So I think we'd like to believe that there's some moral gravity in the universe and that this is going to get sort of crushed, and maybe this working out of private equity books is the start of that. But I think there's just as likely an argument that it's really just beginning. And you can listen to Mark Rowan talk about what Apollo's doing. You can listen to the Alexandria guys talk about what they're doing. Everyone thinks they're building the next Berkshire Hathaway now, where they have an insurance business that is giving them permanent capital to fund a private equity business or a private credit business. And it's a great business model for those folks. But I think, to Dan's point, it's probably not a great thing for end investors. And ultimately, the majority of the capital that all of us are trying to serve comes from people who have worked all their lives and are trying to have a good retirement. And they deserve the best that financial innovation can deliver to them. And this is the opposite of that. Maybe just one thing we could take a look at too. I shared some slides. I don't know if you want to pull up the PDF on venture, but I will make a sort of negative case for venture and then and try to defend it a bit at the same time. This is interesting. What Dan alluded to was that people's assumption has been that private equity generates this kind of consistent 300 or 400 basis point premium to public equity. And interestingly, in the venture world, most people don't think in terms of risk premia. They think that venture should basically have a consistent level of return across time, not a time varying return premium. And so I was really curious to go and look at the data and see what the actual realized premium has been for venture funds. And so this is Cambridge Associates data that I have analyzed here. What you see is under the second column, NPME, that's Cambridge's in-house public market equivalent measure. And not to belabor it, but the reason they have that as their metric is because these are all drawdown funds. So if someone commits $100 to a private equity or venture fund, it's not like they put the $100 in all at once. They're putting their capital in over 5 or 10 years. And so what Cambridge does is they look at what would the equivalent public return have been if you had matched each of those cash outflows into the S&P. Does that make sense? So the cash flow timing is meant to be equalized between the private equity funds they're looking at and the public market. And then what you see here in the middle section are the 50th percentile performing venture funds. And then I just subtracted the S&P's forward return from that vintage year, or the cash, the cash flow matched one from what the venture funds did. And you can see the premium that was actually realized by the venture firms in the 50th percentile of that vintage. So at the very bottom here, what you see, this goes to Dan's earlier point, on average and by median, in every vintage, or meaning the median vintage or the average vintage, the 50th percentile venture funds have lost money. So it would have been terrible to invest if you got the median fund in almost any of these vintages. Then if you go on the right side, what you see is the well-known phenomena that top quartile venture funds do deliver banging returns. So the average vintage has been 13% outperformance of the S&P, and the median performance, the median vintage, has performed 8% above the S&P for any of these vintages. So what you take from that is that venture is a great place to invest, but only if you can find top quartile managers. Now, that would be damning if there were not persistence, but there is a significant evidence of persistence among venture funds, and much more persistence than there is in buyout funds or private equity funds. So the bottom line is venture is a great place to be an investor if you're top quartile, and it's a great place to invest in managers if you find top quartile managers. Let's look at the other slide then. Yeah.
I thought you were going to say the secret to finding the top quartile is all the ones I see on Instagram, because they all advertise
That's where they are.
25 to 50%. And now, to be fair, those are mostly private real estate, but I do see a lot of venture type of offering.
Well, you got to stay away from those ones. But if you can give Sequoia your money or Benchmark your money or me, do it. This kind of gets into, I think, one other interesting topic. You'll hear venture managers often talk about the power law in returns, meaning very small number of companies. This is just like in the public biotechs. Small fraction of companies generate huge returns and everything else sucks. And so you'll hear venture managers say, when we do a deal, we only will invest in something if we think it can be a 100-bagger. And yet we know that if we build a portfolio of 20 companies, 19 of them are going to be zeros, and one of them is going to be that 100-bagger. And I've always thought, that's kind of crazy, because what if you don't get that one? Then you're just admitting that you've got a terrible business model. So we try to think of it in terms of incremental IRR to the public markets. We try to think of it in terms of a targeted expected return premium over the public markets. And what I did here was just try to build a calculator that lets you put in that targeted return hurdle. So if you think about the last exhibit we were looking at, what we said was the median top quartile fund generated 8% over the S&P. And so here, what we're asking is, what gross multiple on an investment in a venture stage company do you need to realize to generate a return that exceeds that hurdle? And of course, it's highly variable across time. So if you look at the bottom panel here, as you go down to say an investment that would not exit for 6 years, it has to be a 4-bagger minimum gross. And so this is kind of our cheat sheet when we're making investments. We have to believe that the realized multiple is going to be in the green.
So is kind of part of this is that you're like, look, we don't necessarily have to have, a batting average that's really low and hit the grand slam. We can do, more reasonable batting average and hit more doubles. Is that your take?
Well, minimum triples or quadruples is the lesson. That's if you're holding investments for 4 or 5 years. And the other lesson is it depends on what the base rates are. Meaning, I don't mean base rates in terms of the sort of probabilities in the broader set. I mean, what are the, what's the risk-free rate? What's the equity risk premium at any given time? What you could expect from venture should be a premium to that. It shouldn't be some absolute number that transcends all periods. And I think that's a fundamental mistake people make. They think of every other sector as having time varying returns, but they don't think of venture that way, and they should.
You and I talked about this once randomly at one of our lunches, DA, where you have a very eclectic menu of interests. And, we talked about trend following and managed futures in the past. And AQR is written on this as well. But when you think of venture and private equity, of all my venture capital buddies, you were the only one. And there's a lot of VCs that listen to this podcast. You were the only one I've ever met that brings up two things, that has ever mentioned two things. One being trend following. I've never met a VC that invests in trend following. I was chatting with Dave McClure about it once years ago on Twitter, where I was like, like these VC or in private equity in general can go through these long bear markets, and like the perfect hedge to me was always thinking about trend following. And the second being 351 type of exchanges, with taxes. So it's good to have DA on here because thinking in terms of these long bear markets as complements and thinking about cash as a good, like if I was Kaiser and I had a 50% allocation to private equity, I would be like, you know what, we got to have a ton of trend following, or we need to have a time varying hedge to this so that if and when we do have the bear market, we have some cash to redeploy when it's done poorly. I don't know many crossover, despite VC being like the ultimate kind of long vol type of investment, that many people think of it that way. I must just be crazy. I don't know.
Well, it works, right? And it's worked over a long period of time, meaning trend. And everything we've been talking about is why it works. People chase the thing that's just made money. And that's a phenomenon as old as time. You don't even need bubbles, by the way, for that to be the case, right? It's the logical thing for people to do. They go, what's making money right now? And I loved when you had Ken French on recently. He formulated this in such a succinct way, which was that, and I'm going to get the tense wrong here, Dan, you're going to have to correct my grammar, but I think he said it's the present participle, meaning there's no such thing as a sector and asset class is making money right now. Nothing is making money. Things have just made money. And if they have just made money, that means nothing about whether they will continue to into the future. And now, trend's premise is that you can count on it persisting for a little while longer, almost always. But when you're thinking about what should I do with the next 5 or 10 years of my life, it's a terrible metric. And that's why people are always citing the thing about MBAs being a negative indicator for which sectors are going to do well in the next decade, right? Like if MBAs are going to work in private equity is about to eat. So, it's like you got to be betting on things whether they're in favor or not at any given time. I think we all share that, right?
And I think there's sort of an interesting point here, Matt, which I feel like sometimes people, right, in some sense, like if you're going to go in private markets, right, you want to go in private markets to like have a concentrated portfolio of like really great things that sort of pass that, hey, they could make 4x or more over 5 years. And I'm going to hold them for that long. And that's what they need to do. But the public markets, you don't need to go and do that, right? Public markets have liquidity. Public markets, you can change your mind. Public markets, you can go long or short, right? And I think it's weird to me that sometimes people, it's horses for courses, right? You want to do the thing that space is best for, right? The public stuff is best for certain things. Private's best for certain things. You don't want to just do a private portfolio in public markets, right? I mean, or a public like you wouldn't want to index venture investments, right? Like you don't want to like apply the best tools of one asset class to the other. But one of the interesting things you've seen is that because private equity has become the darling asset class, so many of the head of private equity got promoted to being the head of the whole endowment or the head of the whole foundation. So they just want everything to look like private equity. And so there's been the squeezing out of these smart diversifying public strategies like trend following, because they just don't map into someone who's grown up in the private equity world, where they just think, well, why would I chase past returns or whatever, right? When I could own some concentrated portfolio of 15 great public names. It's a funny phenomenon how these sort of mental models kind of can take over a whole worldview.
One of my favorite launches this year, which I actually really liked, was, because this goes back to your research a decade ago, was thinking of ways to replicate private equity in the public space. And you've had a handful of ETFs launch, but one of them finally launched on the Thomson, whatever they are now, Refinitiv indexes, but kind of buried in the prospectus, unless you don't pay enough attention, this ETF is that to achieve, and there's other ways to do it, like you mentioned, you could have implicit or explicit leverage on the balance sheet, but to achieve the private equity, quote, outperformance, they're leveraging the portfolio over 2 times. And I think it's almost 2.5. And so to me, like the great humor in that is that the volatility, which everyone assumes is going to be less for private equity, is actually going to be like triple the public markets. And that fund has not raised much money, but it's fun to see it as a, tradable benchmark.
I'm working on a piece now. This is one of my current research projects, but turns out there are which I didn't realize, but there are 12 private equity funds that are publicly listed on the LSE. And they're big funds. I think HarborVest has one. And what's really fun about that is that you can actually just see what the vol is. And when actual private equity funds are publicly traded, well, how volatile are they? What's the beta? And what discount to NAV do they trade at? It's just sort of an enlightening thing. So anyway.
You've pointed out what Meb is speaking to here, which is that you can basically emulate the private equity return stream with publics, levered small cap publics. But do you think that done that way is a good strategy? I mean, is that something people, if your argument is you shouldn't do private equity because you can just replicate that in a public form factor, what's your view as to whether or not in either setting it's a good strategy or is additive to a portfolio?
I mean, I think that you kind of come back to resting on the factor profile, right? Is it a good set of factor exposures or a bad set of factor exposures? And I think generally small and cheap is a good set of factor exposures. To the extent that private equity is buying small, cheap things, I think it's probably a good thing to buy in private markets or public markets. And I think there are places today, if you look at what buyout firms are doing in Japan, for example, most of the buyouts being done in Japan are small and cheap. So I bet buyout in Japan is going to do pretty well. Whereas you go to the US and it's all expensive SaaS software firms that you're paying revenue multiples on and levering to the gills, highly levered micro caps that are expensive doesn't sound like a good factor exposure. So I think that it's sort of matching, what is the underlying asset and what's the reason that you think that underlying asset's going to work or not. And I think a lot of that people miss when they think about private markets or private deals is just thinking through what is the factor exposure here? Am I buying a really small, really unprofitable, really highly levered firm? And is that a good thing or a bad thing as a basket? Yeah, because once you own a certain number of funds, you own the basket, you own the factor exposure, and you've diversified your idiosyncratic risk away. So you should probably understand what it is you're buying.
Think about what I showed with the incredible performance of the top quartile venture funds, and that's been pretty consistent for a long time. If you think about why they've done so well, it's because they tend to capture a small number of companies that are growing at a preposterous rate. And do you think that's easily captured by any of the canonical factors? Meaning, we know for a fact there are these companies. And interestingly, these are not the same companies that Bessembinder has found over a long period of time generate the greatest total returns. But in any individual decade, there are these companies that are just growing at a rate faster than anyone's model would reasonably assume. So do you think there is any intelligent way to identify those or capture those systematically?
first of all, the persistence numbers that you've cited are real to the extent that I've looked at them, right? Like there is top consistency to the top quartile venture performance. There's got to be something systematically that they're doing. And so I think, what is the explanation for that? I think one potential explanation is that once you've got a prestige brand and venture, founders want to work with you. And so, the best founders gravitate towards the best firms. And so they're not going to go to the second tier or the third tier because it doesn't do anything for them. So there's just this sorting or matching effect. And that seems pretty plausible to me. The other sort of more cynical view is that you can buy revenue growth. And so, if you think about what the venture firms are doing, right, they're sort of picking the sexy industries and then buying growth, right? Because these are all losing money, right? So you just massively fund them to grow. And like SoftBank would be like an extreme example of this, right? Like you give the firm enough cash that they can buy the growth to create that. And you can't buy profits, but you can buy revenue. And so I wonder if there's some dynamic there that's happening as well.
What about on the public side? Do you think anyone has, there are a lot of public managers who fashion themselves public venture capitalists, and, they convincingly tell a story about how Palantir is a once in a generation company or that sort of thing. And do you buy any of that?
No, I don't. I don't see any evidence for it. Certainly there are people. I think it's a little bit like it goes back to the Gates Foundation did that like small classroom study where they're like, we looked at the best classrooms and they're all small, and so we should like pay to have all the classrooms be small. And then someone pointed out that like, well, actually the worst performing classrooms are also small. Like small just creates dispersion. It doesn't mean anything about the mean. And I think there's some truth to that in public markets too, right? Like you've got some people that have run these like concentrated 10 stock public portfolios that have done just astonishingly well. But there are probably a lot of people that bought 10 stock portfolios that have just done astonishingly badly. You just don't hear about them.
One of the main reasons I wanted to have you guys on today was having a great time with you and DA's house and listening to Dan talk and y'all banter. But one of the stories I wanted to hear more on is it feels like we've maybe, I don't know, 6 months in, Dan turned a corner on opportunities outside the US. Inside the US, small caps still sucking it up. But outside the US, you're seeing some pretty big moves. Some of these countries up 15, 20, 30, 40, 50%. And you've been kind of a long time, I don't know if agitator is the right word in Japan, encourager, but you were telling some stories about some of your efforts, and we'd love to hear what you guys are up to, what's going on, and how things are going.
Thank God these foreign markets are recovering. I feel like I've been such a promoter of buying, as you have too, Meb, of international diversification because it makes all the sense in the world. And yet for many years, it just didn't pay off. And it's nice to see that it's paying off this year. And either a broken clock is right twice a day. And so, next year, the NASDAQ will be up 40%. International markets will be down again. And we'll all just remember this year as a great special moment. Or perhaps all those charts that show relative valuations of U.S. to international markets with the U.S. at like this crazy peak is starting to reverse. And we're going to start to see fund flows go back outside of the U.S. and valuations mean revert, which is obviously where my money is betting. But Japan is sort of an extreme example where international markets generally have been capital starved, but Japan in particular relative to its size and scale. And a big part of that is that a large swath of the Japanese public market is run for the benefit of the employees and the management teams and not for the benefit of shareholders. But in the last few years, there have been meaningful reforms introduced by the Tokyo Stock Exchange that are pushing these companies to increase dividends, sell non-core assets like public cross shareholdings and real estate, et cetera. And what you've actually seen is a meaningful change where if you look at the dividend yield on Japanese companies, dividend payout ratios, it's like up and to the right. It's just dramatic, the inflection that's happened. And you're seeing the unwinding of parent-sub relationships and cross-shareholdings, and all these really wonderful things are starting to happen in Japan. And as a result, the market has been really rallying, especially in the small cap world, which is where most of these inefficiencies exist. But there's a long way to go. There are these companies' massive real estate holdings, or they're $150 million market cap and they own $75 million in Toyota shares, or $150 million in market cap and they own a $100 million office building in downtown Tokyo, or right, you just see thing after thing after thing. And so one of the things that we've been doing is actually writing research in Japanese about capital allocation and sharing it very broadly with Japanese CEOs and investment bankers and others to say, look, here's the way we see the world. You might not see it the same way, but we wrote an article, for example, on why if your company trades below 1x price to book, you shouldn't spend money on CapEx. Right. It's like, well, the public market is telling you what they value the assets you buy. And if they value it at half of what you pay for them, like, don't buy more assets. Right. Like simple things like that. And we've been, actually getting some decent traction and response from that of people saying, oh, thanks. This is interesting. So we'll see. We'll see if this continues.
That's just the Japanese being polite. They're just saying thanks.
Yep, I think that's right. But I appreciate politeness.
Haven't you made like a significant number of these outreach, like as you're talking to a lot of these companies? It's not like you just send it to one or two CEOs.
No, we're sending it to every CEO in Japan we can find an email address for. So we're, I'm shameless in terms of promoting my ideas when I think they're good. So. And I think it's just interesting to see. I think in some sense there is a cultural clash, right? So like we're writing about like non-core real estate holdings. So like if you own a pachinko parlor, do you need to own like a condo complex? Like no, right? Like there's unrelated businesses, but like that type of thing is so common in public equity in Japan that writing a piece just directly addressing it and pointing out some of the worst offenders. Printing company that's paying to do, massive real estate development or, things like that. We're just, come on, like that, just divest, split them apart, sell one to a J-REIT and do the printing. It's sort of common sense, like 1980s MBA, management stuff that is just kind of foreign to Japan, but the TSE is pressuring companies to adopt them in order to promote more foreign investment. And I think, it's kind of exciting in terms of, being at this inflection point.
It feels like you're seeing a material shift, at least on the top-down macro. You see some of the things like the buybacks, you see some of the other corporate governance behaviors. Is that something you guys are seeing?
Massively, all the time, right? These companies are adopting these plans. There's this company, Nishikawa Rubber, which is one of my favorites, trading at like, 0.3, 0.4 times book value. And they announced that they would do an 8% dividend on equity. So, they just pay an 8% dividend on book value. They traded at like 0.3, 0.4 times book. So, that was a pretty big dividend yield. And investors, within 2 days, the stock went to trading at 1 times book. It's like, okay, you solved the problem, right? And I think a lot of other companies are sort of picking up on that, hey, it's actually, if I'm trading below book value, it's not that hard to trade to book value. I just need to take non-productive assets off my balance sheet and give them to shareholders. And it corrects. And so I think we're going to see more of that, and we're seeing a lot of it. The interesting thing about it is that the entirety of the opportunities in microcaps, it's all of this opportunity has been arbed in large caps for 2 years ago. So there's no opportunity in like the Nikkei 225, right? Like you got to go sub 400 million in market cap to find this stuff. But you go down there and there's 7, 8, 900 companies trading below book value.
That's a lot. Are you seeing any other countries too? I feel like Jeff Weniger from Wisdom Tree is always tweeting about this with Korea. I don't know if it's just a purely Asian opportunity set or.
Yeah, someone says that like Korea is always like 2 or 3 years behind Japan. So I think that there's some truth to that. They're adopting a lot of these same corporate governance reforms. I'm very interested in Korea, but my only problem, which I'll admit, is that I trade only through Interactive Brokers. And for some reason, Interactive Brokers doesn't allow me to trade South Korea. So I email them every month and ask them when they're going to launch South Korea, because the minute they do it, I'd like to go buy a bunch of South Korean stocks, but it hasn't happened yet.
Yeah, I was pulling up a chart of just 2 proxies on the ETF space, and I haven't looked at these funds in many years. Listeners, I'm sure there's better variants, but to Dan's point, the Japan iShares is having a respectable year, up about 10%. But there's the ticker was JOF. I don't even remember who's the sponsor. This might even be a closed-end fund, but the smaller end of the Japanese spectrum is probably double, if not more of that. So you are seeing a pretty big dispersion. Are we ever going to see it in the U.S., man? What's going on? The small caps, are they ever going to, or is that just all the biotechs dragging us down? What's the story?
Well, I think part of it, right, is like biotech, banks, it's been a hard run. I think it has to come back at some point. I just don't know when. It's been brutal to be small cap in the US. I was actually at a small cap, sort of a conference for small cap managers. Interesting, a small group and mostly older. And one of the guys said, did you know that, like, private equity, we were talking about private equity, he said, in the worst year for private equity, which was, fundraising, which was last year, like 700 private equity funds closed. And the other guy looks to me and said, 700 fund managers shut down in private equity last year? And he goes, no. I know that in small cap mutual funds, closing means you shut down your fund. But in private equity, closing means that your fund launches. Just like, it was such a funny moment. But anyway, it's been a wasteland for a while.
DA, what as we start to kind of reach the end of my bladder capacity, that's a good indicator on how well the podcast's going if we make it through full coffee and a water. What else is on your brain, man? You're always curious about all sorts of stuff. Anything else you're thinking about? Preview of your future articles?
Well, I'm thinking a lot about taxes. And Dan and I have spent a lot of time talking about asset allocation broadly, which I think for taxable investors has been tremendously neglected. And in particular, when you start looking outside of just public equities, the tax disadvantages for those of us who are real people are just so tremendous. I mean, it makes everything less appealing. It makes fixed income incredibly unappealing. It makes private equity unappealing. And so I've just, as an individual, been really fixated on how you can build efficient after-tax portfolios, and also been trying to think through some of these questions. I know you had Victor Hagani on. He just wrote a great thing about Roth conversion. And I can show something. I was just wrestling with this recently, and I felt it might be of interest to you and your listeners. This is just something I was doing. I mean, this is just high school arithmetic. There's nothing fancy going on here. But all I wanted to see was, how much do you win over different periods of time by converting to Roth? And I couldn't find a straight answer on this anywhere online. So obviously this sort of depends based on your personal tax rates. But what I did here was, in the left pane, I just looked at if you had a traditional IRA and it was compounding at, say, 10%, and then you paid taxes at ordinary income rates when you withdrew it in retirement, how much did you end with? And what was your CAGR? And then in the middle pane, do the same analysis, except here we're thinking about converting to Roth at the beginning, and when you convert to Roth, paying those taxes with other funds, with other after-tax dollars. And so I considered that tax bill as your opportunity cost of converting. And the way I thought about that opportunity cost was, it's the initial price of that tax, but then it's also how much you would have ended up with if you hadn't spent that money on the tax and instead had let it compound in an after-tax account, and then ultimately paid capital gains on your appreciation. So then in the right is the conclusion. Here's the bottom line. As you go down the years, we've got the percentage by which your ending total cash is greater in the Roth after the conversion. And we've got the incremental CAGR by which your total ending wealth grew. And there's an interesting dynamic here. I was sort of surprised by this, that your incremental CAGR goes down over time. I think the explanation for that is simply that the longer you've got the cash in the Roth account, the greater a percentage of it is the result of appreciation in that account, not the benefit of the conversion. But still, here are the hard numbers. So anyone struggling with this was what I concluded. And I converted 100% of my traditional assets to the Roth, because if you can get an incremental 2% a year for free, why wouldn't you? And that's about what it is for me, with 20 years left to go before I'm 60.
There's no better alpha than tax alpha. I mean, it's often the lowest bar, or you could just be like Peter Thiel, and which one of Buffett's lieutenants did it? Combs and I think Mitt Romney. They all have like multi-hundred million or billion-dollar IRAs, either through private investments or just incredibly good stock picking. It's such a funny barbell because was it Combs? I don't know if it's Combs, but he did it mostly with like on one hand you have Peter Thiel doing it with like Facebook. On the other hand, you have Combs doing it with like Dillard's. Right. It's like you could not have two more.
Well, and he did it sort of like apropos of this analysis, he did it mid-career. And I think he had a big tax bill to pay. Like I think when he did the conversion, he had to pay a $30 million tax bill or something. But the point is, it's rational to do that if you can afford it.
I think in privates, I think the way Mitt Romney, I think that there used to be a way you could split your share classes. So you'd create like a carry class share. And so like you'd put the carry class share in your retirement account and it was worthless because there was no carry accumulated in the investment. And then basically all the carry would go into that. And so a lot of private equity guys did this for many, many years until they closed the loophole.
Yeah, people do that, and they do irrevocable trusts out of state where they put the carry. I mean, there are all these games you can play if you're rich enough for it to matter. And hopefully we'll all be there one day. But I think for the average person, the bottom line is there's a lot of tax alpha to be explored before you even have to hire a lawyer or get into weird exotic stuff. And it's just something no one talks about.
Dan, as you look out to the horizon, you got a bunch of different strategies and funds. What's on your brain? Anything else you're thinking about?
No, I think we've covered a lot of stuff. I mean, I'm probably my big research agenda, honestly, right now. I've been spending a lot of time on biotech and trying to figure that out. So, and then feeling good about private equity's downfall, which I know is a bit of Schadenfreude, but when one is right, one has to gloat a little bit.
That reminds me, who was it we had on the podcast who was the big bankruptcy? Was it Altman? I can't remember who he had. And he said every time there was $1 billion one, he would have a bottle of champagne with his wife and talk about it. It was really funny. So next time we see a $10 billion private equity shop get in trouble doing secondaries, we'll know Dan's having some champagne. Well, I'm looking forward to the Dan DA Biotech crossover fund. That seems like a perfect marriage for you two guys. I just invented a new idea. You got liquidity on the public side, you got the venture capital side. It seems like a perfect marriage.
Good. It'd be a Cambria ETF.
We got too many ETFs. It's like one in, one out at this point. You hit 20.
Matt, I got a question for you. I heard on that Ken French episode, you said, well, why does no one do a global market ETF? And my question is, why don't you do that?
Why doesn't Vanguard do it? There's certain areas that you can kind of do already. Like with 2 Vanguard funds, you could just buy them and basically be there.
And if you don't cap weight, you're effectively factor tilting in some form. The challenge is, how much loading do you actually get on any of those factors with a long only ETF? And if cap weighting is the easy thing where you don't have to think or have a view on anything, how do you think about quantifying the incremental advantage of something that's just a little off?
I've long said I think you can add 1%, maybe 2%. If you go kind of hard in the paint, factor tilts away from market cap weighting over time, and the keyword being over time. The amazing part about where we've sat, I mean, you guys are younger than I am, but we're all in the same ballpark where the majority of our careers since 2009 have been one market environment, essentially, which is S&P face ripper over everything else. And you guys, we interact on Twitter and elsewhere, but we love to poke people and say, look, U.S. stocks could underperform bonds. They could underperform foreign stocks for 4 decades. They could do it for 7 years in a row, which has happened before. And this has just been the opposite of that, right? They've creamed everything else. So it's been a very unique market environment. And, doesn't mean it has to end or has to stop. But I think the flip side of cap weighting, I think it's like it's not like 5-10%, but I think you can get 1% or 2% after fees just by moving away. That's my belief. Worth doing, but it's not going to change your trajectory or outcome, I don't think, for most people. One of the biggest things I've been thinking about and struggling with in some ways is like the U.S. investors, like percentage they own in stocks and household assets. Like I want like every investor to have stock exposure, but at the same time, it's like one of the all-time great contrary indicators. If you look back over the last 70 years, when household assets are at the peak, which they're at all-time high now, of stocks, traditionally that's been a great time to, probably be trimming, and vice versa when they have the least. But then you look at it globally too, and one of the reasons I think that U.S. investors consistently are going to outperform the rest of the world is that they have much higher stock exposure. Most countries, most investors, if you go to Japan, if you go to Europe, the average investors, they don't invest in stocks, they invest in real estate. And so that, compounding makes a difference over time, assuming they have a little global exposure too. So I'm always conflicted on that topic.
It's so hard to get a picture of flows that is accurate. And so you have to ask yourself how much of this kind of US dominance has just been a function of flows from those global investors. Everyone's talking now about what does it mean for international sovereigns to de-risk on US treasuries or US equities just a few percent, and how consequential that could be for these asset prices. And, the inverse of that, like to the earlier conversation topics is, let's say these Japanese corporates just start doing what they should do. Like, what does it mean if Japanese households recognize that and say, look, we're going to put a few more percent into our domestic equities? That could really drive those returns every bit as much or more than the fundamental business improvement that those management teams generate through their actions. So that's, I think, one of the great questions is, like, are we wasting all our time thinking about the wrong source of returns if the one that really dominates ends up just being flows? But they're so hard to predict.
Fast forward the end of the year, NASDAQ's up 50, international's flat. That's most likely outcome. Gentlemen, y'all's funds both open. We got some qualified, accredited investors listening to this. They want to knock on your door. Are you guys still accepting investors?
Call us. And I'm an investor in Dan's Japan fund. I'm a big believer. I think it's awesome. So people should beat his door down for that one.
Perfect. Well, listeners, you're feel free to bug them directly. Where's the best place to find you guys? Websites? DA, you first?
Twitter, DA Wallach, or X, DA Wallach, or da@dawallach.com.
And I'm at Verdad Cap on X, and Dan at verdadcap.com is my email.
Gents, it was a blast. Blessed to have you both here today. Thanks so much for joining us.
Thanks, Meb. Thanks, DA. This was fun.
Thanks, Meb.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.